What's up, everyone? Welcome back to the Afro Investor page and YouTube channel. It's another week, more dollars to be made. Another day, another dollar, as they say. It's about 3 o'clock right now, so the markets are closed for the day. And this is officially going to be the first proper post on the channel. So we're just gonna start from the basics to hit it off. So like I guess like everyone's watching this video probably knows, this is all about this is a long-term investing channel. I'm just here to break down the principles and the core terms around investing and long-term strategies. I'm not offering signals of companies to go invest in, or day trades or things like that. Again, I'll be using those for references and examples, but that's about it. I'm not here to preach on go buy up this stock and flip your money tomorrow or flip your money next week, whatever. I got nothing against that too, but I'm more concerned about understanding the basics and the principles and being able to learn this so that you can make your own choices and investment decisions on your own without necessarily having to listen to some guru or follow or somebody's advice from social media or Instagram or what have you. You can have the conviction and confidence to make your own investment choices for yourself. So first thing on the dock is I'm gonna go through the different investment classes, the different ways people can invest in the financial markets to make money and gains or dividends, things like that. So the first one obviously is going to be the stocks and bonds market. So what's the stock market? The stock market is basically a public exchange platform for individual investors like yourselves and myself, or institutions like companies, private companies, financial institutions like banks, or super rich investors with 6, 7 figure, 8 figure accounts with 8 figure accounts worth of capital. So all it involves is people buying and selling the shares of publicly traded companies. Not every company in the world is publicly traded. Companies are privately owned, which means there's no public investment in them. All the decisions are completely privately based. Publicly traded companies, on the other hand, usually have a board of directors, a CEO, who have to make sure things are in check to ensure that investors' money isn't just being wasted. That's all that still happens, but more with as time has advanced, all the good companies, all the strong standing companies have always had to adopt proper business operations and business strategies to make sure that they remain investment worthy. Because when companies are traded in the stock market, their share price is a representation of their market capitalization, which means the market capitalization is basically a product of a share price and the number of shares the company has available to trade in the public. So the higher the market cap, the more strength a company has financially, and the more access they can get to receiving more loans to increase their business scale or things like that. So the higher the market cap, the better business is the general rule of thumb. Of course, there's instances where the price of a share of a company shoots up insanely over a brief period of time and their market cap goes up. But again, if you look over time, the strong, best companies usually have the higher market caps in the market. So the stock market involves buying and selling shares of companies for different reasons, for different strategies. People buy and sell companies just to trade on a regular basis, to try and buy at a low price to sell at a higher price. People buy companies because they believe in the company's business, they believe in the company's operations, company's procedures, and they believe the company is only going to continue improving in its worth. So they buy shares in the company and hold them so that the worth of the shares keep going up and they can receive capital gains. Capital gains just simply means the increase in value of shares that you own already from the time you bought them. Similarly, you can also experience a loss in share price after you invest in a company. The price could equally go down. There's no medicine ball or whatever that predicts the future that tells you, oh, for sure this one is going to go down or this one is going to go up. That's why long-term investment strategy is usually better than short-term trading or day trading, if you will. Over time, long-term investing has always returned better gains than day trading or short-term trading. The stock market since its creation in the 1800s has been in an upward trajectory over time. Again, there's been plenty of periods, months or years where it had a downward dip, but the overall trajectory from the start so now has been in the up. And like everything that goes up, there are always going to be down times. So, and the downtimes are good for those with long-term mindsets, because that means the market has dropped to prices below fair value, aka at a discount. So that's usually a good time to buy up shares, because again, if you're in it for the long term, you know that they're gonna go back up again and you're gonna get gains and gain value. So that's the basic of how the stock market works. It's important to remember when you're buying and selling shares, you're not always buying it or selling from or to the company whose shares you're trading. You're buying and selling them from other investors, other traders. So you should keep it in mind that the price of a share isn't necessarily the share price of a company isn't always at every time representing the true value of the company. It's usually it could be at any time, be at its current prices, just based on current market sentiments or current economic conditions, things like that. A perfect example is the current pandemic. So last year, by February, March, most countries around the world started imposing lockdowns on citizens, and started advising everybody to stay home. And because of this, a lot of investors were fearful, because nobody really had an idea of how long the lockdowns were going to last or what the effects of the lockdowns was going to be or things like that. So you can say the sentiment became fearful in the market, and most investors became fearful and were worried that that their stocks are going to lose value, going forward because of the pandemic imposed lockdown. They weren't sure there was going to be more economic activity. So the market went through a crash because there was a huge sell-off. Everybody started selling off their shares to turn them back into cash, so they can have cash on hand for whatever consequences were coming. Like, some people thought it was going to be like a zombie apocalypse. Like at the start of the pandemic, there was a whole lot of fear that there's a whole lot of people that are going to die or fall terribly ill and things like that, which is still going on, but it hasn't been as bad as was originally pictured. So as a result of that, in March, the stock market had a very deep dive. It lost about, I think, 40% in value as a result of all the sell-offs. Like, everybody was selling off. Hedge funds had to sell off to create cash for their investors and things like that. So that turned out to be a good time for long-term investors to buy up shares again, because companies had lost considerable value in their share price. And since April, after the American Fed announced that they were going to inject more dollars into the market, all the fear was erased. People started getting confidence back, like, okay, it's not as bad as we thought. Economic activity would still go on. And so people started buying up shares again and drove the market to even higher prices than originally before March. So right now, with the crazy upward trajectory the market is in, we say it's in a bull run. A bull run simply means the good times for the market when things are pointing upwards. The other side of that is a bear run, which is when the market is pointing downwards. So when they say the market is in a bull run, it means it's upwards, and when it's a bear run, it's downwards. Bears and bulls, keep that in mind. The bears are always looking up, and the bulls are always looking up, and the bears are always looking down. Various ways to invest in the stock market. You can have your individual investing account through your bank, through a brokerage account. For Canadians, that's your Wealthsimple, your Questrade, Interactive Brokers. In America, they have the now infamous Robinhood, there's Webull, there's Charles Schwab. There's multiple apps, brokerages that you can use to open investment accounts. People also invest through hedge funds. Usually this is for people, again, with high net worths, because the hedge funds usually have a minimum amount you have to invest in to have access into that fund. So what the hedge funds really means is a pool of a huge amount of dollars from its investors. So usually like 20, 30, 40, 50 billion, if not more, that's given to the hedge fund, who has a fund manager, and it's this person's responsibility to pick out the best companies to invest in with the fund's money. And as the investments make gains, the investors receive gains also, because it's their money that's being put to work, and the fund manager gets paid obviously for their activities in making money for others. So yeah, that's another way people invest in the stock market. And then another part of the stock market is also the bond market. Now, the bond market is not really about companies, it's more tied to the government. And what this entails is the government actually collects loans from individual investors like yourself and myself again, or from institutions, and collects these loans on a fixed term, so like a 2-year term or 5-year term or whatever. And the reason why they collect these loans is for projects, like for government work. So they collect the loans as bonds from people. So you give the government your money, and you'll be awarded a bond contract, and the government will use your money to build roads, build infrastructure, hospitals, or whatever. And then depending on the term of the bond, say it's a 5-year bond term, if in that 5 years the government has put my money to work building up roads, new roads, and now the increased income from all these new services, either from taxing people or whatever, is going to be regarded as the gains in the bond, right? And so I get my loan returned back with interest from the government, and then those loans don't get taxed because they're payments back from the government. On the other hand, when you invest in the stock market, the gains that you make are usually taxed up to certain percentages. A loophole around that, now in Canada we have tax-free savings accounts, TFSAs. You must have heard that if you're working already. And it's a tax-free savings account. It means exactly what it's called. So there's a yearly limit that you can invest into your tax savings account. But with that limit, any gains you make from that amount is all going to be tax-free. So currently the yearly contribution amount for Canadians is $6,000. So if you invest $6,000 into your tax-free savings account and you buy up shares in the company, and say perhaps you hit a gold mine, and the $6,000 worth of shares you bought somehow goes up to $1 million, your $1 million is going to be tax-free income. Amazing, isn't it? So that's a very, very useful piece of nugget for everybody to keep in mind, is using your tax-free savings accounts to build up your gains first and collect them tax-free. And similarly, if you don't use up your contribution limit for a year, it accumulates. So since the TFSA has been implemented into the Canadian economy in 2009, a lot of people aren't privy to it, including myself. I wasn't privy to it until a few years ago. If you haven't been using your TFSA limit, it's been accumulating since 2009. So at this point, 12 years now, if you haven't used your contribution at all, for 2021, you would actually have up $76,000 to invest tax-free. So that's a pretty good deal, I would say. Imagine the kind of gains you can make from $76,000, and you wouldn't have to worry about filing no taxes for those returns. So that's a pretty big plus. You can also invest with the regular trading account that gets taxed. Any gains you make get taxed on that one. So those are two differences to keep in mind. And another a benefit also from investing in companies in the stock market is dividend payments. So I believe up until the 80s, nobody was really invested in companies if they weren't paying dividends. Dividends simply represent income the company is making per share that's available publicly, and they pay that out to their investors. And it's usually they usually pay it out either monthly, quarterly, that's every 3 months, or every 6 months, or once a year. Like in the case of Warren Buffett owns, I believe it's 40 million Coca-Cola shares, and they pay about he owns 400 million Coca-Cola shares, and their dividend payment is 40 cents a share. So every year, whether he lifts a finger or decides to do nothing throughout the whole year or whatever, as long as he owns his 400 million shares, Warren Buffett gets $160 million back in dividends every year from Coca-Cola. So mind you, if he could have bought up all these 400 million shares 10 years ago, 20 years ago, 5 years ago, and hold from the time he owns those shares, his dividends start accumulating. So he doesn't have to buy any more shares. As long as he's holding the 400 for the rest of his life, he's going to be getting that 160 mil check every year. Obviously, hitting 400 million shares in a company is probably a bit far off for a lot of us, but you can still evaluate. I mean, and at the same time, my bills definitely aren't the same as Warren Buffett's bills, so my requirements at this time aren't as high as his. He's a billionaire, so obviously his life is different. you yourself can figure out what your regular regular bills are in your life, like say your phone bill, your insurance, your rent, whatever. You can pick some bills out, figure out how much they are, every 3 months or whatever, and find a good company, say like Apple, like Coca-Cola, like a bank, TD Canada, Bank of America, that a lot of companies pay dividends. You can figure out how much dividend they pay per share, figure out how many shares you would need from that company to cover your bills, and then start working to invest in that amount needed in that company, however long it's going to take. This is not a one-day thing or a one-week thing. We're talking about long-term or bust. We're talking about a lifetime here. We're talking about 10 years, 5 years, 20 years. We're talking about building net worth for our kids, for our grandkids, for our great-grandkids. This is not just about us. It's bigger than us. So that being said, dividends are a very, very good incentive to think about investing. You'd be sleeping and making money. Like I wake up now to notifications that, oh, such and such has deposited X amount in dividends into your account for your X amount of shares that you own in the company. It's a great feeling, honestly. Like I've been laid off work since March 2020, March last year, because of the pandemic, and it was a fire I needed under my butt to get me started thinking of other ways to start, generating income without relying on a job. And I've been fortunate to discover some gems in the stock market. So that's something I like us to think about, is the benefits of dividends. And also I should mention, dividend income is taxed like regular income. So just like the amount of taxes you pay in your regular 9-to-5 job, dividends are considered salary like that essentially. But again, this is income that you're making without having to work, you don't have to go nowhere to get this income. It's working for you while you're doing other things. So having to pay some tax on it, sure, I don't mind, especially considering if also the company is also getting gains in the share price. So you can be getting an increase in share price and increase in dividends, because dividends is a percentage of the share price. There's obviously way more info to dig into on that I'll let you guys go find. Next is the options market. Now, the options market is a whole lot more risky than investing in stocks, because options are tied to expiry dates. What it entails is when you trade options, you're trading contracts of shares in a company. Now, each contract represents 100 shares in a company. So if I'm trading an option contract on Apple, it means I'm trading the rights to control 100 shares in Apple, which currently will be worth about $11,300. If I'm not mistaken, I think Apple is at $113 right now, $130. If it's $130, so you're talking about controlling 13 grand. Now, you don't need, if you wanted to buy 100 Apple shares, you would need to have $13,000 to buy those shares. But you can trade an Apple contract for much cheaper. That would give you the power to control the shares. With the options contracts, you don't necessarily have to buy the shares. You just buy the contract. You buy in and sell the contract. So you can end up selling the contract to somebody who can afford to buy the shares. So a basic coverage of options involves buying and selling calls or buying and selling puts. So with the options market, if you're looking at a company and you anticipate like, oh, this company is about to get some good news, or something good is about to happen to this company and their share price is about to go up, you can buy contracts that will let you buy shares of the company at a lesser price than it's currently trading at. So again, back to the Apple example, Apple is currently trading at $130. Now, if I expect that in 2 weeks it's going to go up to $150, I can go in the options market and look for contracts that will let me buy Apple at $140 in 2 weeks. So if I'm right that Apple hits $150 in 2 weeks and I have contracts that let me buy that at $140 at that same time, my contracts are insanely valuable, because somebody can buy 100 shares at $140 and sell them in the stock market for $150 and make a $10 gain per share. So that's $1,000 quick right there. So that's how options work. The contract prices aren't the same as the share price of the company. They're based on other factors and things like that. So when you're buying the contracts, the numbers won't usually so the contract to buy Apple at $140 in 2 weeks could be worth like $240 right now. That's letting me control $13,000 worth of shares. So the contract prices are usually much lesser than the actual share prices. So again, I buy the contract to buy 100 Apple shares at $140, and in 2 weeks Apple is trading at 150 a share. And I have no interest in buying those 100 shares, but definitely there's plenty of people who'll be interested in buying those shares, especially at a discount. And that's where I would sell the contract and make gains, because say I bought it at 240, now in 2 weeks it's probably worth now like 800 or 900, a much higher amount than the 240 I bought it for. And then I will collect my profit and gains. Options again are taxed like regular, option gains are taxed like regular income, so keep that in mind. And there's also the futures market, where, believe it or not, people can actually make bets on what they expect the future prices of stocks or other assets to be in the near future. And there's a whole lot of money in the futures market to be made. I'm not fully versed on it, I'm still learning about it, but it is definitely another valuable tool to have in your repertoire, because I've seen, from what I've seen, like the gains can be pretty crazy with just little amounts of work. So I don't have much to say on that currently, but definitely as we go, I'll provide more info. So I've spoken about stocks, bonds, options, and futures so far. Next up is commodities trading. People trade grains, people trade seeds, people trade water, people trade wood, lumber, tin. You can actually trade these in a financial market. And it's not the same as the stock market where you buy one piece of wood or a bag of grains or whatever. This is just, again, almost like options, where you're trading contracts that control the value of certain commodities. So, okay, currently in the US, they're going through a blackout in Texas. So, and a lot of plants are shut down or places are shut down. So, as the consequence of that would be an increased cost of production of food in that area of the US. You know, it's going to cost more time, effort, and money to produce things with lack of electricity and things like that. So obviously the price of certain commodities in the area will go up. Somebody who somehow was privy to, maybe 2 days before, knew, like, got the early news that a snowstorm was hitting Texas or blackout was coming, whatever, they can react to that and, you know, start buying up cheap contracts for commodities, because they know in the next coming days it's gonna go up due to the incoming incidents, or the incoming snowstorm and things going on in Texas. So again, I'm not too well versed in commodities, but I know it involves dealing with commodity items like grains, seeds, farm feeds, things like that. Again, you can go look up more if you're interested. And then another asset class is precious metals. Now, as people always make money in the stock market always going up and going up. During the down times, people also make money because they're invested in precious metals like gold and silver. These are considered hedges against cash. So when the stock market is bleeding and prices are dropping, you would usually see that the price of metals like gold and silver would usually go up. So if you already own some gold, maybe more precious than this, you know, or more carats than this, or silver or whatever, it's good to have those to hold those for a long time, because whenever the stock market dips, the increase in value, you can sell them, get gains off those also. And then when the stock market recovers and prices go back up, the metals would usually go in reverse and go back down, and then you can buy them again to start holding. So it's I'd say for starting out investing, just to keep your gains and future protected. If you're investing in stocks, it's also helpful to look into investing in some precious metals just as a hedge for whenever your stock portfolio takes major dips, you know. So it's very possible to invest in gold and silver. You can actually order a gold bar and it'll be delivered to your house, and it's yours to own. Whenever you want to sell it, you figure out the price in the market and you can sell it. Or you can get little pieces, little chips. You can buy gold and silver in different amounts. So that's about it for the precious metals. And as we all know, gold and silver can be used for different things. Jewelry, you know, electronic devices, all kinds of things. And the newest member in the investment class, still controversial, still not fully accepted, is the crypto assets. And we all know the big boy in that space to be Bitcoin. But there's actually like 500 different types of crypto coins available in the crypto market now. But the leaders are your Bitcoin, your Litecoin, your Ethereum, you know. And then most of you might have heard of Dogecoin because of Elon Musk and things like that. The reason why crypto isn't fully accepted now is because it's still a whole lot of unknown factors around it. The identity of the creator isn't really known. His name is known, but nobody knows actually who he is. It could be anybody. There's no telling. And governments and big financial institutions are still feeling, they're still holding opinions against it because it can't really be controlled like cash. Like any activities you do in your bank account, you transfer money, you know, any purchase, whatever, it can be pinpointed right to you like right away. If you use your account for any fraudulent activity, the bank can access that info right away and figure out who's who that did what is what. With crypto, coins get traded on a blockchain space, identity free. So I can send somebody $1 million worth of Bitcoin right now, or use $1 million worth of Bitcoin to fund some illegal activity or something right now. And while people will be able to see the transaction in the blockchain space, they can't tell who was on the sending end and who's on the receiving end. They could have wallet addresses, but there's no way to identify whose crypto wallet is whose. So if somebody's serious, they can monitor a wallet's activities, but they unless the owner of the wallet identifies himself, it will never be known. So activities can still be monitored, but identities can be made. That's why governments are still scared against crypto, because they're making a case that it can be used to fund illegal operations and untraceable and da. And we're seeing that is not entirely true, because humanity is generally geared towards good. People are beginning to accept Bitcoin as a form of payment. We heard that Tesla just bought up 1.5 billion worth of Bitcoin and are planning to start accepting Bitcoin as payment for Tesla cars. So with that being said, that's the conclusion for today's video. Hopefully I was able to shed some light on the different investment classes that you as an investor can take advantage of. Multiple ways to build your wealth out there. You can even invest, people even invest in art, Buying art is an investment process. You buy it for a price and sell it. You can hold it for many years and sell it at a higher price later. So there's definitely different ways to build an investment profile. So I'll leave you guys with that for today. And in the next video, I will go fully in on the stock market, the benefits of having a long-term mindset and understanding how gains and dividends and all that work properly, full on in the stock market. So hope to see or hear from you guys again. Thanks for tuning in. Everybody take care. Afro Investor checking out. Peace.